Welcome back to my channel. Please subscribe to my channel and hit like button if you like this video. This is the updated version on trend identification. If you have not watched my previous video on the trend identification, please watch it also. Trend identification in forex involves recognizing the direction in which institutional investors and experienced traders are moving their capital. These entities typically have significant resources and market insight, so their actions often foreshadow broader market movements. Identifying trends according to the smart money concept involves understanding the flow of capital and making informed decisions based on that understanding. Trends can be categorized as uptrend or bullish trend, sideways or ranged movements, and downtrend or bearish trend. In this episode we will discuss about uptrend and downtrend only. We will cover only the definition of a sideways trend before moving to our main topic. In a sideways or range-bound trend, the price fluctuates within a horizontal range or channel without forming clear higher highs or lower lows. This suggests indecision in the market and can occur during periods of consolidation. Before moving to uptrend and downtrend identifications, let us discuss briefly about the impulsive waves and corrective waves. As you know that the financial markets move in a series of waves, both up and down, driven by crowd psychology. These waves are composed of impulsive and corrective phases, forming a repetitive pattern. The theory identifies two types of waves. Impulsive waves, these waves move in the direction of the primary trend. And corrective waves, these waves move against the primary trend. An uptrend is characterized by a series of higher highs and higher lows on the price chart. It indicates bullish sentiment, with buyers dominating the market. As the trend progresses, investors often witness periodic pullbacks or consolidations, followed by renewed upward momentum. In an uptrend, higher highs are broken and higher lows are protected as shown. A downtrend is characterized by a series of lower highs and lower lows on the price chart. It indicates bearish sentiment, with sellers dominating the market. As the downtrend persists, investors may witness brief rallies or consolidation phases, often followed by further downward momentum. In a downtrend, lower highs are protected and lower lows are broken. As you are aware of uptrends and downtrends, we will now focus on identifying trends before they undergo a change. This involves preemptively recognizing shifts in market direction or momentum. By closely monitoring price action and key technical indicators, traders aim to anticipate trend reversals. Identifying early signs of trend exhaustion or divergence can provide valuable insight into potential trend changes. Utilizing trend analysis tools and pattern recognition techniques can aid in detecting emerging market shifts. Apart from others' method, there are three very simple practices to determine the strength of a trend. Number 1, the highs and lows. Number 2, measuring the gap between sequential retests. Number 3, clustering price action. Let's discuss the highs and lows in detail with example. To begin, Let's initiate by visualizing the formation of highs and lows on a chart over a specific period, essentially examining the evolving relationship between them over time. Now, let's consider an example. The first lower high was the first sign that the uptrend was beginning to fatigue. But it wasn't until the first lower low that we had a telling indication that the current trend had reversed. Keep in mind that trend changes will not always be this obvious. But the signs are always there. Measuring the gap between sequential retests, an effective method for assessing trend resilience. Let's delve into understanding strength of a trend by incorporating key levels alongside swing highs and lows. It's crucial to recognize that multiple retests of a level heighten its visibility but don't necessarily fortify it. The notion that repeated retests bolster a level contradicts the reality that a level could potentially break, regardless of the number of retests it endures. If we acknowledge that multiple retests don't strengthen a level, it doesn't necessarily imply that they weaken it either. While frequent revisits to a level might hint at a potential breakthrough, it's insufficient evidence to predict such an outcome. To assess the likelihood of a breakthrough, we examine the relationship between highs, lows, and our key level. In the illustration provided, the market demonstrates respect for a trend line, yet the intervals between each retest diminish over time. The first retest was in 10 days. The second in 5 days. The third, in 3 days. And the last one was in 1 day only. By measuring the gap between the retests we can forecast the strength of ongoing trend. This phenomenon suggests a decline in demand, resulting in shorter intervals between price retracements from the trend line support. Consequently, the market spends more time consolidating rather than achieving higher highs. This principle is applicable to bearish trends as well, where increasing demand and decreasing supply drive prices lower. Clustering price action, an early warning sign. Lastly, another important consideration arises when price action consolidates around a significant level. This approach amalgamates aspects of the preceding techniques we discussed. I often refer to this phenomenon as intense price action, signifying sustained pressure on a key level within a brief time frame. Perhaps a more fitting term is warranted, as intense seems apt for scenarios where pressure is exerted on a support level. The essence lies in observing the market's reaction to support, or resistance levels within a specified time frame, typically spanning a few days or even a full week when operating within the daily time frame. If the market consolidates extensively around a key level, it often hints at an impending trend reversal. The illustration depicts such behavior within an uptrend, showcasing how the market clustered near support, signaling an imminent breakdown more often than not. Determining the strength of a trend doesn't need to be a complex operation. Something as simple as the 3 techniques discussed above are all you need to gauge whether a trend is likely to continue or break down. Thank you so much for watching this video. If you enjoyed the content, and found it valuable, please consider subscribing to our channel for more updates, and exciting content in the future. Don't forget to hit the notification bell, so you never miss out on our latest uploads. Thank you again for being a part of our community, and we look forward to seeing you in the next video.